Hi, once again, good day. And this is Vinod Kothari once again. Today, we're going to talk about topic which is connected with promoter shareholdings. If you are connected with any promoter group, or if you're advising any promoters, or if you are a promoter yourself, and you have operating companies in your group, and there are non-banking finance companies, so-called investment companies, holding shares of your operating companies, which obviously receive dividends from the operating companies, then you need to listen to this small address, because there is a difficulty as well as tax efficiency if the shareholdings are held through investment companies or non-banking finance companies. So you need to listen to this address. You may also read more details in one of our articles on the subject, the link to which you can find in the description box. The situation is as follows. In view of the regulations or regulatory powers that that the Reserve Bank of India has on non-banking finance companies, one of the recent regulations applicable to non-banking finance companies is the restriction on payment of dividends. Restrictions on payment of dividends are quite common in financial entities, but in case of non-banking finance companies, particularly investment companies, the relevance of these restrictions is a matter of question. However, regulation is regulation, and from financial year 21-22, this restriction is applicable. Therefore, it applied last year and continues to apply thereafter. The restriction is that an investment company shall not distribute more than 50% of its current year's profits. Please don't send 50% of current year's profit. Therefore, there is no question of distributing past reserves. Even from the current year's profit, the maximum distribution can only be 50% of the profits earned during the year, which would actually mean half the profits of the NBFC will get reserved, would stay in the NBFC and stay in the so-called accumulated surpluses. This is something that happens year on year, because every year the same restriction of 50% does apply, even though the statutory provision section 45 IC of the RBI Act talks about reserving only 20%, but the RBI has made 50% mandatory retention in case of all non-banking finance companies. Let me once again repeat. This is applicable to non-banking finance companies in general. It's not limited to NBFCs of a particular size. So all non-banking finance companies are covered by this restriction applicable from financial year 21-22. Now let's understand what's the implication of this. A promoter entity, an operating company in the group, distributes dividends which go to the non-banking finance company in the middle. Obviously, the non-banking finance company is simply conduit. That's not the ultimate beneficiary or ultimate holder of the shares. The shares are held by a network of entities above. Essentially, the promoters, the individuals are sitting somewhere at the back, somewhere at the end of the spectrum. There might be a layer of entities in between, which one after the other continue to hold shares, and the dividends are supposed to be relegated from the operating company to the non-banking finance company, from the non-banking finance company over to eventually going to the individuals, the promoters at the back. But that's where the difficulty comes, because the operating company distributes dividends, it goes to the non-banking finance company. Half the profits will get reserved there. Only half can be distributed, and therefore half of the profits will necessarily be reserved there. The moment we talk about distribution of only half of the current year's profits, please do understand the provisions of Section 80M of the Income Tax Act. Therefore, the dividends received by the non-banking finance company will mandatorily be taken as income, and that income will be deducted only by half the profits which have been distributed. That would mean the other half will mandatorily be taxed as the income of the non-banking finance company. Now, the money has not even been distributed. Therefore, half the income will get taxed at the hands of the non-banking finance company itself. Now, given the fact that this is something which is happening year on year, therefore, there is a bulging of profits at the NBFC level, and eventually at some stage, as the non-banking finance company distributes the money to its shareholders, there would once again be either a tax in the hands of the recipient shareholders, or there will be a tax by way of a tax on buybacks if the entity adopts a buybacks, or let's say the eventual distribution happens on liquidation of the company. There again, there'll be a tax at the stage of release of profits on liquidation. So what we're therefore basically talking about is that the profits have already been taxed at the operating company level. post-tax profits are distributed by way of dividends. The dividends are not passed through because it cannot be passed through. Only half can be passed through. The other half will mandatorily get stuck at the NBFC level, but get taxed there. And when it's distributed, it will get taxed in the hands of shareholders. Again, we're talking about a triple three-layer tax in case of shares held by non-banking finance companies. If the restriction on dividends wasn't applicable, then the matter was not as complicated, because if the dividends received from the operating company were completely distributed, then the non-banking finance company will get full deduction under Section 80M for the dividends distributed. And therefore, there would not be the additionality of taxation at the NBFC level, as the dividends distributed will get deducted, and therefore there will be no tax or no income to, at least no income by way of dividends to pay tax on. Now, this is not the only problem when it comes to creating layers of non-banking finance companies, basically garbing the identity of the promoters. There might have been multiple reasons or multiple motivations in the past to create these layers or layers of entities. But in the current scenario, it's most important to keep shareholding structure simple. Instead of letting the promoters, the ultimate beneficiaries, stay in the shadows, it's important to bring them right on the operating company level itself. And therefore, if you have non-banking finance companies holding shares of group companies, I would very strongly advise these companies could think in terms of merger at the operating company level. Therefore, the shares of the operating company are held directly by the promoters, the ultimate beneficiaries, instead of being held by intermediary entities. This entire matter has been discussed at length in our article, as I gave reference to that. So it's very important, and because the restriction is recent, just about a year old, maybe people have not actually realized the seriousness of this, but it's very, very, to my mind, it's something very serious and therefore needs attention. That's the objective of this address. Thank you for listening to me, and have a very, very nice time. Thanks.